Namaste one and all. And now I am going to explain about the regulatory measures towards consumer credit and bank credit to NBFCs. The Reserve Bank of India issued a circular on November 16, 2023. This is most important and regarding some regulatory measures towards consumer credit and bank credit to NBFCs. It is explained in the circular. Before going to this video, I request you all to please like, share, watch and subscribe our YouTube channel Suvarna Chundi, and also I thank you very much for watching our videos and getting good knowledge about the latest developments in banking and banking topics as per Reserve Bank of India guidelines. RBI issued a circular with reference number RBI bar 2023-24/85 DOR.STR.REC.57 bar 21.06.001 bar 2023-24 dated November 16, 2023. Why I am telling this reference number? Some of my banker friends already asked in my YouTube channel, please give reference number also, sir, for in case any doubts are there, we can go and refer that particular circular. This circular issued by RBI addressed to commercial banks, including small finance banks, local area banks, and RRBs. RRBs means regional rural banks. Of course, non-banking financial companies also, including housing finance companies. Here, the subject is regulatory measures towards consumer credit and bank credit to NBFCs. Usually, bi-monthly credit policies are going on by Reserve Bank of India, MPC. MPC means Monetary Policy Committee. During the Governor's statement dated October 6, 2023, flagging the high growth in certain components of consumer credit and advising banks and non-banking financial companies, that is NBFCs, to strengthen their internal surveillance mechanisms, address the build-up of risks, if any, and institute suitable safeguards in their own interest. The Reserve Bank Governor, Mr. Shaktikant Das, in his statement dated October 6, 2023, stated that banks and NBFCs are their consumer credit is growing up like anything, and they should take care of some risks which are involving in financing consumer credit. In that statement, he has highlighted about that the high growth seen in consumer credit and increasing dependency of NBFCs on bank borrowings were also highlighted by Governor in the interactions with MDs or CEOs of major banks and large NBFCs in July and August 2023 respectively. So Reserve Bank of India Governor already discussed about the increasing dependency of NBFCs on consumer credit and banks also and bank borrowings, etc. Already he has highlighted regarding this during the MD and CEOs meeting. In this context, it has been decided to effect the following measures as under. RBI has decided to go for various types of measures in the form of this circular. It is advised to the banks and NBFCs. Number one is consumer credit exposure. Consumer credit, you know all, consumer credit means retail advances. Consumer credit exposure of commercial banks first. We will discuss about consumer credit exposure of commercial banks. As per extant instructions applicable to commercial banks, consumer credit attracts a risk weight of 100%. Presently, consumer credit risk weight is 100%. On a review, it has been decided to increase the risk weights in respect of consumer credit exposure of commercial banks, of course outstanding and as well as new, earlier outstanding also and for new advances also, including personal loans, but excluding housing loans, education loans, vehicle loans, and loans secured by gold and gold jewelry by 25 percentage points to 125%. So, consumer credit new risk weight will be 125%. Earlier it was 100%. Since consumer credit increasing alarmingly, the Reserve Bank of India governor taken a note of this and discussed with MD and CEOs of various banks and NBFCs. It has been decided to enhance that risk weight to 125%. Next, consumer credit exposure of NBFCs. Earlier we have discussed just now consumer credit of commercial banks. Now consumer credit exposure of NBFCs. NBFCs means non-banking financial companies. In terms of extant norms, NBFCs loan exposures generally attract a risk weight of 100%, like in case of commercial banks also 100%. On a review, it has been decided that the consumer credit exposure of NBFCs, of course outstanding and as well as new, categorized as retail loans, excluding housing loans, education loans, vehicle loans, loans against gold jewelry and microfinance bar SHG loans shall attract a risk weight of 125%. So there is no confusion here for my viewers that is bankers. Please note down that regarding consumer credit for commercial banks as well as NBFCs, that is retail advances, consumer credit exposure risk weight, earlier it was 100%. Now RBI governor enhanced it to 125%. That means 25% increase is there. What about credit card receivables? Next, as per credit card receivables, as per extant instructions, credit card receivables of scheduled commercial banks attract a risk weight of 125%, while that of NBFCs attract a risk weight of 100%. So, scheduled commercial banks credit card receivables risk weight is 125%, whereas NBFCs risk weight is 100%. On a review, it has been decided to increase the risk weights on such exposures by 25 percentage points. So, in all the cases, commercial banks, NBFCs, consumer credit as well as credit card receivables, in all the three cases, RBI decided to increase 25% risk weight. So here, on such exposures by 25 percentage points to 150% and 125% for SCBs and NBFCs respectively. Here there will not be any confusion to viewers, that is my banker friends, on a review regarding credit card receivables for all scheduled commercial banks. It has been increased to 150% from 100%. Whereas in case of NBFCs, actually it is 125%. For scheduled commercial banks from 125% to 150%, whereas NBFCs from 125% from 100% to 125%. So both scheduled commercial banks 150% now and NBFCs 125%. It is very clear that only 25% is risk points increased. What about bank credit to NBFCs? First of all, we have explained that commercial banks consumer credit, afterwards NBFCs consumer credit, afterwards credit card receivables to scheduled commercial banks and NBFCs, that is now enhanced to SCBs to 150% and 125%. What about bank credit to NBFCs? In terms of extant norms, exposures of scheduled commercial banks to NBFCs, excluding core investment companies, are risk weighted as per ratings assigned by accredited external credit assessment institutions. It is, in short, we can say that ECAI. Please note down, some of the examiners may ask in their promotion examinations or JIB or CIB examinations, please expand the full form of ECAI. ECAI means External Credit Assessment Institutions. On a review, it has been decided to increase the risk weights on such exposures of SCBs. SCB means Scheduled Commercial Banks by 25 percentage points over and above the risk weight associated with the given external rating. Whatever ECAI given external rating plus 25 percentage points. In all cases where the extant risk weight as per external rating of NBFCs is below 100%. If it is below 100%, 25% risk weightage points to be enhanced or increased. For this purpose, loans to housing finance companies and loans to NBFCs which are eligible for classification as priority sector in terms of the extant instructions shall be excluded. So please note down, loans to HFCs and loans to NBFCs which are eligible for classification under priority sector in terms of extant instructions shall be excluded. So apart from these other advances, all are if it is below 100% given by risk rating given by ECAI, then 25 percentage points are enhanced or increased. Strengthening credit standards. Why it has come this? Actually, Reserve Bank of India wants to strengthen the credit standards among the banks or REs or NBFCs, etc. etc. What are the measures it is taking? The REs shall review their extant sectoral exposure limits for consumer credit and put in a place, if not already there, board approved limits in respect of various subsegments under consumer credit as may be considered necessary by the boards as part of prudent risk management. So here consumer credit highly increasing towards this segment, since it is highly increasing towards consumer credit segment, now Reserve Bank of India requesting or giving instructions for strengthening credit standards towards board approved limits in respect of various subsegments under consumer credit. In particular, limits shall be prescribed for all unsecured consumer credit exposures. Whenever it is there is no security, automatically getting repayment is highly difficult. Hence, they are in particular limits shall be prescribed for all unsecured consumer credit exposures as per Reserve Bank of India guidelines. The limits so fixed shall be strictly adhered to and monitored on an ongoing basis by the Risk Management Committee. Risk Management Committee of the bank should review it and it should be monitored on an ongoing basis. All top-up loans extended by REs means regulated entities against movable assets which are inherently depreciating in nature, such as vehicles, shall be treated as unsecured loans for credit appraisal, prudential limits and exposure purposes. So whenever against vehicles advances are given, automatically some depreciation will be there and vehicle value will be in the reducing nature. Hence, all top-up loans extended should be taken care of it. These all above instructions have been issued in exercise of the powers conferred by the Section 21 and 35A of the Banking Regulation Act 1949, Chapter 3rd B of the Reserve Bank of India Act 1934 and Section 30A, 32 and 33 of National Housing Bank Act 1987. These sections also sometimes in the examinations we have to face it. Hence, please note down these sections. These are most important. Nowadays, JIB and CIB examinations also, they are very twisted questions they are giving in the examinations. Hence, please each and every point please observe, and it is most important. And our videos also I am concentrating particularly to enlighten the young bankers to go for getting more and more knowledge. And also finally, before closing this video, the above instructions other than some shall come into force with immediate effect, that is with immediate effect means as per the date of circular November 2023, and also all REs shall endeavour to comply with the provisions at whichever are not applicable at the earliest, but in any case shall implement them by not later than February 29, 2024. So these all by all regulated entities and all NBFCs should implement these all guidelines from February 29, 2024 at any cost. Thank you one and all for watching our video, and I request you all once again to subscribe if not subscribed so far YouTube channel Suvarna Chundi, and I thank you very much for watching our video. Namaskar.